because Hi everyone, thank you for attending India Avenue's webinar, which is a review of 2025 as well as an outlook towards 2026. We appreciate your attendance. This meeting will be recorded and we will supply to those who are interested a copy of the recording as well as the summary. Please feel free to ask any questions via the chat or the Q&A section, and at the end of the discussion we will go through those questions prior to completing the webinar by roughly 11:15. Okay, we can get started. So essentially we thought we'd start initially with a discussion around Indian equities as an asset class and cover some of the material just to give that validation of why the India story should be considered independently as part of portfolios. Firstly, an important thing to consider from a long-term perspective as opposed to shorter-term iterations is that over the course of the century so far, India remains one of the most powerful markets in terms of overall annualized return. We can see here that from the turn of the century, the orange bar has been far superior to other asset classes, essentially. When I say other asset classes, I'm referring to regional equity markets, such as MSCI World, MSCI EM, China, Australia. For example, the compounding that has been provided by India has been close to 11 times over that 25 years, which is in the low double digits in Australian dollar terms. So relative to other markets that, as you can see, has been quite superior. And when we flip to the next slide, you can see why that is the case. So this is essentially earnings over the last 20 years on an annualized basis. You can see India's annualized EPS growth has been low double digits, call it 10% roughly, which has been superior to other markets like the US, which has been a very strong growth market essentially for the last 10 to 15 years, as well as the likes of Australia and New Zealand. Indian corporates have produced strong earnings growth. The important factor here is also to look at the volatility of that earnings growth on a year-to-year basis. When you take yearly volatility, you can see not only is India's earnings growth superior, but it also has low volatility. And that's largely because it's avoided earnings recessions experienced by the Western world, which tends to have sector-based or theme-based rallies and then boom-bust type cycles. So India, with its broad, diverse market, has had less exposure to these sort of recessions over time. And that's why the volatility of the earnings growth has been quite low. So from a long-term perspective, investor sentiment, which is guided by return volatility, risk return matrix, India looks like a good place to consider as part of a portfolio. And one of the things we'll see later in this presentation is equity investing of locals into Indian at about 7%. Additionally, the currency is also becoming increasingly stable. You wouldn't think that from what we've seen in 25, but over the longer term, India's currency has certainly provided more strength to the fundamentals of investing in the region, as well as a strong buildup of forex reserves from its increasing export nous. We now move to the 3-year correlation to exhibit what we are talking about in terms of an asset class, as well as from a currency perspective, from a correlation and volatility point of view. You could see India offers meaningful diversification benefits. When you look at the rolling correlation over 3 years compared to Australia, global equities, which is MSCI World, and China. So you could see India's correlations has continued to drop over time. And this is because largely a function of its economy being more local demand driven. It's still relatively a newcomer when it comes to exports, and its own regulatory, political reform, and demographics are creating some distinction and dispersion from where the global economy is going. Okay, next slide is also reinforcing that same view on a volatility basis. We could see over time, the conception and view or perception is, that India has been a very volatile asset class, which was much more so in the past couple of decades. What we have seen with the increase of local investing in the region is India's rolling volatility on a 3-year basis drop further towards where emerging markets or the world or Australia is in terms of volatility. So this is basically annualized standard deviation over a rolling 3-year period. So now that we've covered some of those more longer term fundamentals of why one might consider investing in India, we go into more recent behavior over the last 5 years in particular. FY20 to 24 in India was an exceptional period. Strong corporate recovery from the COVID period. Corporate profit to GDP surged to a 15-year high, which was above 5%, after a subdued period in essentially the 5 to 7 years before COVID. This was driven by some cyclical as well as structural forces in banking and financial services, oil and gas, which recovered strongly post COVID, automobiles, consumer durables, and broadly benefiting from rising and strong economic activity over that 4-year period. Additionally, input costs were much lower, particularly in 23 and 24 as they came off an inflationary period. GDP growth was above 7% for that period on a real basis, and corporate profits rose 3 times faster than that. So you had a period of stable macro, strong push on manufacturing, broader participation across the economy and across various segments of the economy, including the bottom of the pyramid. And this led to, as you can see there, strong returns from the market, as well as very strong period of profit growth, which was around 20% CAGR. When we flip to, from a returns perspective, what this means, when we look at India over that period, you had at the end of 2024, 1-year returns of 22%, 3 years of 13.2, and 5 years of 15.4, sitting well ahead of whether it was emerging markets, Australia, or the MSCI World, which remember had a high weighting to the US. So India was driven by their strong earnings, and you can see from the small chart at the bottom left that emerging markets was something that India basically left behind. Its weight in emerging markets went from 8% all the way up to close to 20%. Valuations as a result of this strong, robust earnings growth reached a point of 24 times 1 year forward by September 2024. When we then reflect on what's happened in 25, there are a tale of two things there when you look at the charts on the top. Firstly, FIIs, that is foreign investors into India, traditionally been a strong supporter of Indian equities, given the demographics. We saw that, like we did in 2022, when there was a growth handbrake put on India, we saw foreigners exit India due to a few factors: higher valuations, a sign of weakening earnings growth from the rampant pace of 20%, as well as concerns from a macro political point of view, given what President Trump was saying in terms of tariffs on India. So 2025 year to date, and we're almost at the end, has been a year of underperformance for India against other regional equity markets like emerging markets, US, which have been strong, seen strong support from foreign investors. One thing to note, however, is local investors, DIIs, have seen a structural investment into Indian markets really over the last 5 to 10 years. We've seen that now getting to an average of about $4 billion US a month going into equity markets from local investors. This has supported India, reduced volatility. We saw that previously as to why rolling 3-year volatility was dropping, and it's largely because of a growing cohort of local investors who are preferring equity investments to fixed income in India. Another factor behind the weakness in returns for foreign investors, particularly, is the depreciating rupee. We could see here that essentially over the previous 9 years of us running our fund, the rupee to the Australian dollar hardly moved. A lot of that was caught up in 2025, where we saw India come from an overvalued position on a PPP basis to a more fair value, I would say, level. And that has happened as we've seen US trade tariffs and tensions, foreigner outflows, foreign investor outflows of nearly 17 billion US, strong dollar rate differentials and current account pressures, which has also led to weakness for the rupee. Additionally, the central bank of India has not stepped in to intervene so much. And that is because, in light of the events of what's going on globally, India has preferred to have some currency depreciation in a bid to diversify and strengthen its exports as an added arm to its local consumption and demand-driven industries. So we've seen an environment where India is taking a more medium to longer term view in terms of improving and strengthening its competitiveness of exports and making it more robust in an environment where trade tensions exist. And we've seen, therefore, the rupee fall up to, I would say, 10 to 11% against the Australian dollar. Given Aussie dollar has also gone through a period of strengthening to the US dollar over this year. When we look at the underperformance of our fund, as many investors who have been with us for some time will know that generally our fund tends to outperform during phases where the India growth story is intact, and will take a brief phase of underperformance when the handbrake is put on. And the reason behind that is essentially we are investing in India to identify growth at a decent valuation. There are times when that growth is curtailed or slower, where investors will choose to hide in cash type proxies, or perhaps areas like more cyclical companies. Our focus is really to find that structural story with decent valuation over the long term. At certain points in the cycle, we accept that there will be some weakness or underperformance whilst people in the short term question the growth story. So you could see here that our sectoral position very much favors some of the domestic consumption stories that can be backed by financials, as well as consumer discretionary. Additionally, infotech and healthcare, which is more focused on the export story, and we'll talk about why that has provided Some hiccups along 2025, whilst it still seems to be the place where India will thrive on going forward. Now we move on to the outlook and positioning. Essentially, from a positioning point of view, we realized that by the end of coming towards the end of 2024, that it was going to be an environment which was a little bit more difficult for us to make alpha. And in this environment, we had curtailed our active share, as you can see, essentially from the end of 2024. We did this by increasing our exposure to larger cap companies, which essentially will naturally reduce your active share as you introduce a greater weight towards companies which are higher constituents in the indices. However, that's not necessarily our natural long-term positioning, which tends to favor, as we saw in the previous chart on the on the top left there. Over the long term, the fund tends to focus on lower market cap than the benchmark, which would be the horizontal purple line. And it also tends to favor better valuation than the benchmark, which is the vertical purple line. So you could see the observances of those red dots, which are essentially 1 month at a time, that today we are probably the highest cap we have been over time. And from a valuation point of view, it's not at the lowest or greatest discount valuation, but it's certainly still very much on the cheaper valuation than the broader market. So when you have a very heavy or top heavy benchmark constituency, you will naturally find that most funds that take an active position or a non-benchmark or a benchmark unaware position will have a underweight position on a market cap basis. But also thrown in with this is essentially our preference for cheaper valuation while finding growth. So in India, you'll hear most commentators or portfolio managers talk about the fact that India is an expensive market. We try to solve this by digging further down the cap curve to find companies which are still growing and exciting, but not necessarily loved by all foreign investors as yet, and perhaps are underinvested on an institutional basis. So that thesis will generally work in our view over medium to long-term timeframes, but will suffer some underperformance in periods where there is increasing concerns sentiment-wise or a risk-off behavior which is aggressive. When we move to the size distribution, which is a function of what I was talking about, you could see that from really when we saw the markets getting expensive to a point where small caps particularly had become expensive relative to the typical discount they operate at relative to large caps, we had started curtailing our small cap exposure and increasing our large cap exposure in a point at a time when we felt perhaps there would be a pause in Indian equity markets while some of the macro policy headlines had to be dealt with, and whilst earnings growth was slowing from the aggressive 20% per annum we saw from 20 to 24 towards a low double-digit number. In FY25, we saw earnings growth of 10%, which is still healthy and still matches the long-term profile we showed you earlier. We think over the next 3 years, we'll see earnings growth between 10 and 15% in India. So whilst we have increased our large cap exposure to counter for this difficult environment in 25, it's not something that we think is structural in the fund and in our positioning. The structural position would be, again, to find growth stocks at a decent valuation that can lead to some of these companies entering perhaps the large cap space over time. And when we move to the outlook for 26, we think Indian equities will have some renewed momentum, which is supported by an earnings recovery. We've seen that in the last quarterly earnings, and we'll expect that to continue into the December quarter earnings. We see some moderating global risks for India through the diversity in its export profile and potentially some free trade agreements that it can enter, and foreign inflows to return once they identify India's resilient earnings growth after a period of weakness. As I said, we've seen recovery starting to occur in sectors like financials, automobiles, and industrials, which should drive growth, and we expect IT services and pharmaceuticals to recover after a weak 2025. When we think about the Trump tariffs, it's important also to note that both IT services and generic pharma are two industries which are not tariffed. Generic pharma is exempt from tariffs because it feeds into the US healthcare system and keeping costs under control. And IT services is a service and is not therefore not tariffed. And when we talk about the H-1B visas, which Trump has been quite vigilant on and has increased that cost of that visa to 100,000 from closer to 5,000. It's mainly the US companies that are using that visa. The largest user of the H-1B visa is Amazon, actually, and it's not so much the Indian IT services firms who knew this issue may present itself at some stage and have started recruiting directly from the US and have used work from their own location more successfully post-COVID to maintain their profitability. So not so much of a concern when you look at it in an actual point of view, but more from a perception point of view. We do think there's a lot of noises coming out on trade negotiations with the US and Europe in terms of a deal being done and the final aspects of that being put forward. That should be positive because it's not necessarily priced into the market today. India's relative valuations to emerging markets are now approaching close to a low point that we saw at the bottom of COVID when India had that strong outperformance. That's giving us confidence that foreign investors will rethink their India positioning. Most of them are underweight at the moment, so we can see some flow coming back to India once this robust profile of earnings returns. Interest rate cuts have also seen 125 basis points of cuts in 25. We've seen GST being rationalized with the top rate of 28% being brought down to 18%, which is quite aggressive. And we've seen quite a lot of consumption-based holdings, benefit from that, particularly in two-wheelers and four-wheelers. Personal income tax threshold or the tax-free threshold has been increased. So that's also beneficial. All those things will feed into consumption. And we think exports are set to grow after a sluggish period from the first half of the year up to September for goods exports. We think that will start to improve given India's focus on diversity to its exports. When we look at Indian corporates, again, positive signs. Indian corporates have been de-leveraging for a decade now. Debt to equity of the top 500 stocks, excluding financials, has fallen to 50%, the lowest over this century. Low leverage improves resilience for these companies against global shocks. And with the healthier debt profile they have, they can think about CapEx and private investment. So essentially debt raising, whilst it continued to rise, more companies favored public equity raising, raising 92%, the highest ever in FY25. So several companies also came to the market through an IPO. We're seeing as an impact improved financial health for most corporates, potential to increase capacity utilization, more favorable macro conditions upcoming, a government focusing on infrastructure build out, both physical and digital. And areas like power and renewables, capital goods, manufacturing, consumer industries should benefit. The India story, however, will still depend on global demand, geopolitical stability improving, and some domestic policy clarity to be shown. So it's not an island and will depend on a better environment globally, and perhaps for some of these trade deals to be completed so that India can truly fit into that supply chain diversity, China plus one thematic, as well as seeking to increase value from its exports rather than purely volume. I exhibit what I just said in this slide. I know some of the writing may be small, but if you look at the column which is net debt to equity, you can see that net debt to equity has dropped dramatically, and the total debt to equity is now pretty much getting close to 50%. Margins have been high, and asset turnover is improving, and ROEs, you can also see, are improving. This is the top 500 companies exponential. The golden phase for India was 2004 to 2008, essentially. That was when corporate earnings were rampant, ROEs were high, and the spread between ROE and the 10-year government bond was high. We're just starting to see an acceleration in some of the same fundamentals in the last few years. 2025 has been a pause, but Indian companies are well positioned to generate high ROE. Rates are at a low point, and the spread is starting to get towards double-digit numbers. Companies are fueled for, with the additional equity that they've raised to be able to spend on the next upcoming cycle. So with that, I'll have to show you the disclaimer page, which you can quickly read through. But with that, we come to the end of our webinar presentation. We're happy for any of you to reach out to us individually, as well as the question answers that have come through whilst the course of this presentation. So we can probably take some of those now.
Yep. Just a reminder, you can post your questions in the Q&A section, or you can put it in the chat and we will compile it. So the first question comes from Pete. Thanks for the question. It is around the level of foreign currency reserves at present. I guess that's quite important given the currency movement this year.
Yeah, so Forex reserves are not at the peak level, which were over US 700 billion, but there hasn't been too much reserves used to defend the currency. Currently, we're at about 675 billion. So India's Forex reserves have improved tremendously due to IT services, essentially bringing dollars in the door from the rest of the world. Some of that will be used occasionally to defend currency, but I think interesting in this scenario is that India is aiming for an orderly depreciation to support its export competitiveness, which should improve earnings profile over time, but it takes a hit on investors from a foreign perspective over 2025.
And if there's no other questions, I'll ask one myself. What are some of the main risks for corporate earnings growth for next year?
Yeah, so the main risks for corporate earnings growth would be weak global environment, lack of any trade deals eventuating, and slowdown in India, which is driven by perhaps rising inflation. Today, inflation is running at sub 2%, which is below the bottom end of the central bank's forecasts. However, if the scenario changes and a weaker currency is importing inflation into India, then this could certainly create margins coming off their peak levels and earnings growth slowing, which will have an impact on the market.
just have a few other questions coming in. One from Brandon. What is the allocation to your fund manager ideas and some comments around that?
Yeah, so the allocation for us, we use three external managers to essentially they're advisors. We place all the trades ourselves and we implement all the positions. But the three advisors have been focused on increasing exposure to domestic plays in their portfolios. They have also been increasing their exposure to larger cap companies in an environment where perhaps some of the growth ideas in small caps starting to trade at a more expensive valuation. So we think at some point towards the early part of the next year, we'll start seeing more attention being paid to perhaps some of the companies in mid and small caps as we go through this underperformance period. But we've seen our advisors being actively moving around their positions based on what they're seeing in the environment.
Yeah. Next question from Gary. Do you think the 50% Trump tariff will be negotiated down? And if so, what sort of time frame?
Yeah, so the internal views in India is that that tariff can be negotiated down to about 15 to 20%. We've seen some discussions and some activity already with India curtailing its purchases of Russian energy. India's argument has always been that Europe and China buy more than India itself. However, and India was being, single-handedly victimized in that sense. But we've seen activity already that would indicate that they're negotiating towards a lower tariff at some point in probably the first quarter of next year.
Yeah. So next question is from Kanhai. It's around, I guess, the issue of governance, which in the past has impacted investor confidence. So what gives you confidence for stability at the moment and access to investment?
Yeah, look, I think one of the reasons you would actually invest in India is because over the last 5 to 10 years, governance has improved substantially relative to where it was. Governance is always going to be a question mark when you have a stock market which is 45% owned by founders. There's the pro and con of that. One is, some people seek to invest in founder-led companies, but in that you also have a majority shareholder which controls and overlaps sometimes with management to drive the company forward. So we've seen lots of measures put in place by the regulator, by the central bank, by the government in terms of providing some separation between the founder and management, bringing extra diversity to boards, ensuring that educational qualifications of board directors are standardized. And we're also seeing that, a lot of our advisors are very much focused on governance from a stock picking perspective. That's why we think, in a biased way, it might be, that active management is a better way to play Indian stock markets with a firm filter on governance towards companies which are conscious of minority shareholder interests as part of the, outperformance over time in the actively positioned portfolio.
Yeah, this one is probably less an investment question, but more investor access. So a quick answer would do from Jay Murphy around the rough timing on Hub24 access.
Yeah, so Hub24, as well as many other platforms, we have the India Avenue Equity Fund. You can also access us through our ETF, IAEF, which is being listed on markets now for 9 months. The India 2030 Fund, which we haven't talked about today, which is for high net worth and sophisticated investors via an IM. We should have a response on that from Hub24 in the very early part of the next quarter.
And next question is from Jay Kumar. Any thoughts on the Indian airline industry and portfolio names?
Indian airline industry is essentially one company which owns 65% of market share called Interglobe Aviation. It is a company that's undergone some issues due to some flight cancellations over the last couple of weeks that will lead to some weakness in its share price. It is one of our holdings and has done very well for us since COVID time. Given its market share has been strong, the company's been a market leader and has made very strong profitability. However, it has faced the difficulty of being profit focused in the sense that some of the airline shortages that were brought about by having a very acute focus on profitability had led to pilot shortages, which has led to the issues that we've seen in the last week. So one of the issues of having a focus on stock specific positioning in your portfolio is sometimes some of the companies that you own may go through a difficult phase. We think Indigo is a great company longer term and essentially plays the fact that Indians want to travel more from a very low base, and having 65% market share, it's the leading player in that space.
A follow-up question from Brandon on the comment on the INR, and is it likely to see a small improvement here on AUD and USD basis?
I don't expect a strong rebound of the currency. What I do expect that it's found closer to a newer home where we are. I do expect if there is a trade deal that gets inked, that the currency will strengthen a little bit from the position it's been in. India still has very strong macro, growing real GDP above 8%, inflation below 2%, and strong foreign reserves. So I can't see a scenario where it goes through the fragile 5 days that it was labeled in 2012, 2013. In fact, lots of things have improved substantially since then. So I would expect that orderly depreciation has largely played out. And from here, we expect to see the result being stronger corporate profit growth profile as exports become far more competitive.
And just the last question, I guess, before we wrap it up, from Bill. Thanks, Bill, for the question. Has there been much growth in the Indian IT sector, or has the US, trade tensions and trade impacts affected earnings? I guess outsourcing by the US tech giants was an obvious growth driver. So how is that at the moment?
Yeah, so I don't think the tariffs really impacted Indian IT services. It was slowing growth in a few industries, which had an impact. Essentially, India outsources and consults to businesses to build greater efficiency and improving profitability in those businesses. Over time, it's gone from purely cheap labor as a comparative advantage to now having a broad suite of things that it can offer, like migrating to the cloud, digital enablement, and increasingly AI integration for several firms, particularly in the US and Europe. IT services saw a weaker period in terms of earnings. We saw some layoffs as they'd hired many people at the bottom of the pyramid, and now some of them were leading to a natural, transitory period. We think going forward, actually, this segment looks quite interesting as it will lead the integration of artificial intelligence to across a lot of the firms in the world. And we are starting to see a pickup in activity in the last quarter in terms of earnings growth and projects being won. So we think valuation-wise, this is a prime candidate for outperformance in 2026.
And maybe we'll just squeeze in the last question. Thanks, Gary, for the question. Any comments on the recent second quarter GDP numbers? So that's over 8%. Is this sustainable?
Yeah, so there's one thing to look at: real GDP and nominal GDP. So it was a very strong real GDP number, but we live in a nominal world. Corporate profits and companies make their profits in a nominal world, and nominal GDP was only just below 9% because inflation was so low. So it was a strong phase. We had a lot of front-ended activity, particularly on the export side, prior to tariffs starting to be in place. So it's going to be interesting to see whether this growth is sustained into the next quarter. We think it will be because there's been such a focus on domestic consumption. We're seeing some of the activity of two-wheeler motorcycle sales and auto sales and SUV sales, being very strong, driven by this, incentives towards consumption. Lots of agencies like IMF, World Bank, Central Bank in India have upgraded economic forecasts for GDP for India for FY26, which is March year ending, to closer to 7%. So I think, the interest would be, is all of this sustainable over time? We think, eventually India needs the export story and these trade deals also to take place to go back to that 15% plus growth profile in terms of corporate earnings. Okay, thank you very much for joining the webinar today. For anyone who's interested, we'd be happy to send you a recording as well as the summary notes taken by our note taker. And we wish you all a great Christmas and a holiday festive period, as well as a great start into 2026, and we'll touch base with you then. Thank you very much. Signing off. Goodbye.